Very good evening to all of you. And I can see Sagar and Tanvi. So good evening and bless you all. Okay, so before we go ahead, I just want to recap what we have done in the last class. Okay, so what we had discussed in the last class was about ex ante to ex post to ex ante. Okay, and then we had shared that difference between classical and Keynesian concept. That Keynesian John Maynard Keynes is also known as father of macroeconomics because he introduced the concept of government, which has to bring the economy back on track when there is deficit demand or there is excess demand. We have also shared the concept of full employment. We have shared the concept of involuntary unemployment and deflationary and inflationary gap. So the last class, what we had covered about deflationary and inflationary gap. Just to recap before we go ahead, deflationary gap basically is about the gap between full employment. It is less than the full employment level. And what is full employment? Full employment or equilibrium level. What do you mean by equilibrium level? Equilibrium is when you say that aggregate demand is equal to aggregate supply. So this is the condition of equilibrium. And what are the components of aggregate demand in a two-sector model? We have shared two sectors as consumption and investment demand. So this is the two-sector model we have shared last class. And aggregate supply is represented as Y. Y is GDP or national income of the country. Because here we are talking about there is no external factor. So that is GDP is equal to national income. Okay. So that is consumption demand and investment demand is equal to national income. That is aggregate demand is equal to aggregate supply is the condition of equilibrium. This is what we have shared. And in the short term, what happens? Investment is constant. So what drives income or aggregate demand? Aggregate demand, as we have shared, has two components, consumption and investment demand. And in short term, investments remains constant. So the aggregate demand is governed by consumption demand. Now, who creates consumption demand? Consumption demand is created by household. And we have shared what Keynes had proposed as consumption model in the last class, just to recap, because once we go ahead, you should be able to connect. Okay, so consumption is a function of disposable income. What is disposable income? Disposable income is income plus transfer receipts minus taxes. What is transfer receipts? Transfer receipts are the payment which are made by government or any entity to the household sector without rendering any services in return. For example, allowances given. For example, pension given post-retirement. For example, some subsidies are given to, I would say not subsidies to individual or to the household sector. It is given in terms of interest subvention. For example, I say that when you take loans and others, so interest subvention are given, subsidies are given to you. Okay, that's about transfer receipts. Taxes, basically, if the tax rate goes up, obviously your disposable income goes down. What is disposable income? Disposable income can also be written as we had shared in national income accounting, C plus S. That is consumption. Either you go for consumption or you go for saving. That is your disposable income. Income which is available with you to go for disposing of in terms of consumption. If you don't want to consume certain percentage, you'll go for savings. Okay, so these are some important identities which you should remember. So consumption function given by Keynes, how consumption function has been redefined by Keynes. He has stated consumption is equal to A plus B by D. What is this A stands for? A stands for autonomous consumption. What is autonomous consumption? If this YD would have been 0. Okay, so if this YD is equal to 0, that means this whole becomes 0. That means consumption is equal to A, autonomous consumption. In other words, autonomous consumption is a consumption at 0 level of income. That is autonomous consumption. Now, what is the sanctity of this autonomous consumption? This autonomous consumption is there always, reason being, if your income is zero, that doesn't mean you will stop consuming. So that is what is autonomous consumption. That means this consumption is not dependent on income. But what about this B? B is also known as slope, or you can say marginal propensity to consume. What is marginal propensity to consume? It is delta C by delta Y. What it means? It means that if your income in the country increases by 1 rupee, and if I write MPC as 0.5, that means 50 paisa of this 1 rupee will be consumed, and obviously 50 paisa will be saved. Okay, so that is the concept of marginal propensity to consume. With each additional unit increase in income, how much percentage of that you go for consumption? What proportion of it you go for consumption is known as MPC. Now, if you go for consuming 50 paisa, that means your MPC is 0.5. Then in that case, you are saving how much? You are saving 50 paisa. So MPS, that is marginal propensity to save, will be 0.5. And the next identity which we had defined was MPC plus MPS is equal to 1. So these are some important terminologies which you should know about before we go ahead. MPC is marginal propensity to consume. MPS is marginal propensity to save. These two are dependent on what? These two are dependent on disposable income. What is disposable income? Disposable income is which you spend for consumption or savings. How do you get that? You get it by national income plus transfer receipts minus taxes, disposable income. Number 3, you should know that consumption is a function of disposable income. Higher the disposable income, higher is the consumption. Number 5, when we talk about consumption function, it has autonomous consumption and it has marginal propensity to consume. Autonomous consumption is a consumption at zero level of income. And marginal propensity to consume is dependent on disposable income. Higher the disposable income, higher will be the marginal propensity to consume. If marginal propensity to consume is higher, marginal propensity to save will be lower. So these are basic terminologies which you should know about before we go ahead for this particular class. Okay, so these are the basic terminologies which you should know about. Now, before we go to the next, so marginal propensity to consume is if the consumption in the country increases, if MPC goes up, that means country is consuming. Consumption demand is there. If consumption demand is there, then in that case, you are creating demand for whom? You're creating demand for goods and services. Who is producing those goods and services? So corporate will go for investments. So corporate investments will increase. Investment increases means employment increases. Employment increases means income increases. And income increases means further demand for goods and services will increase. So aggregate demand will increase. And this aggregate demand increases because consumption demand is increasing. So consumption drives economic growth. Okay, so consumption drives economic growth. If there is deficit consumption, aggregate demand is deficit, then in that case, this will lead to deflation, deflationary gap. If there is excess aggregate demand, then it leads to inflationary gap. If there's deflationary gap, that means aggregate demand is less. And if aggregate demand is less, then corporate will go for producing less. If they'll produce less, they'll go for less employment. Less employment means less income. And this leads to decrease in the national income of the country, unemployment increases in the country. So this is deflationary, opposite is inflationary. That means here what is required is that aggregate demand needs to be increased. And to increase this, who will take the charge? Government will take the charge. That is what Keynes said about. How government will take the charge? By expenses, by increasing the expenditure. Like what kind of expenditure you see? They may make flyovers, they may make roads, they may make schools, they may make hospitals, they may create job opportunities by training programs. Like today you see we have startups government is promoting. For example, government is going for Skill India, government is investing on health, government is investing on education, new education policy. So all these expenses will lead to what? Lead to more investments. And investment increases means output increases. And output increases means income in the country will increase. So this deficit demand will be overcome if government takes the charge. Okay, so that's very, very important to understand. What's the role of the government and who proposed this? Keynes proposed this. When did he propose this? In 1936 through his book, General Theory of Employment, Interest and Money. This was based on 1930s Great Depression. What is Great Depression? When aggregate demand was too low, deflation was there, depression. And then government brought it back on track. Same we have seen during COVID cases also. COVID time, government has taken the charge because we had deflationary gap. Okay, so these terminologies you should know about. Now, today we are going to share something very interesting, the concept of multiplier. Okay, so what is multiplier exactly? To make you understand with the simple multiplier, we are going to talk about multiplier. Multiplier means if I say that, let's say for government flyover, government has invested 100 crores for the flyover. And MPC of India is, let's say, 0.5. Okay, so if government has gone for investments of 100 crores, if MPC is 0.5, that means what? 50 crore will be consumed and 50 crore will be saved. Now this 50 crore which is consumed will create income in the hand of some people. And if MPC remains same 0.5, that means 50 crore, 25 crore they will be going for further consumption. And 25 crore they'll save. Now if MPC remains 0.5 only, out of this 25, again 12.5 will be consumed and 12.5 will be saved. And this goes on. Are you realizing that through 100 crore, how many jobs are created, how much income is created? So multiplier helps you to find out that by what multiple income is generated in the economy by unit increase in investment in the economy. And this is normally represented as K. K is the symbol of multiplier. And this you calculate, how do you calculate? You calculate by change in income to change in investments. Or you can calculate it by 1/1 minus MPC. Okay, so let's say if I write consumption function as consumption is equal to 50 plus 0.50 YD. Okay, now if I want to find out that what is the multiple level of income generated in the country, with unit increase in investments. How will I find out? We know this formula. Okay, so I should use some other color. Okay, so you know this. What is MPC here? This is MPC. Isn't it 0.50 is MPC? So I can find out the value of multiplier. That means K is equal to 1 upon 1 minus MPC. That is 1 minus 0.5. That is 0.5. That is 2. So the multiplier value is 2. Now, if Government of India is going to invest 100 crores, how much income will be generated? Additional income will be generated? 200 crores, because 100 into 2, that is 200 crore income. Yes, you can find out through the MPC only. Okay, you can find out through MPC, depends what is given to you. Now, related to question, Sahil's question related to what is the format of the answer questions in the exam. It is, questions can be related to numerical, questions can be related to concepts. So you should know both the things. And let me tell you very clearly, all of you over here, the ICI is not looking for your mathematical ability. They are looking for your concepts and its application. So any numerical question given to you is not about just calculating numbers here. You should know the implications. You should be able to draw inferences through that. And if you're not able to draw inferences, then in that case, you will score less marks. So do not expect just by writing in numeric terms, you have achieved the purpose. And that is why it is very important, first and the foremost, to understand all the concepts and then go for analyzing. Okay, so do take care about this. So what is important here for the multiplier, what we have shared till now, we are talking about investment multiplier. What is investment multiplier? Investment multiplier is, if you increase investment by unit, how much multiple times income is generated in the country. Okay, how many multiple times income is generated in the country? So how do you calculate that? That you can calculate with the help of MPC. And how do you know MPC? You can know that with the consumption function if it is given to you. And if you go through examiner's notes, comments, they have highlighted n number of times that students, they are not clear about these concepts, and that is why they are not able to score good marks here. So the concept should be very thorough, and then you can solve the numerical, any numerical, and you can draw inferences also through this. Okay, so this is the concept. So I hope the multiplier concept is clear. You can take real life example also. When flyover is constructed, how many laborers are working? They are rendering their services, in return they are paid salary, isn't it? They get salary. If they get salary, they spend. They spend means it creates income in the hands of others. From whom do they buy? Those who get income, they also further spend. So this creates multiple chain of income generation. And that is why you see the impact here. So higher and higher the value of MPC, higher will be the multiplier impact. And impact is higher in developing countries. That is why you see one road constructed in India creates so many jobs, helps so many dots to connect. That means the impact of multiplier is immense. So developing countries, multiplier impact will be higher. Okay, so that is what you should understand. So the concept of multiplier is clear. Sujal, once again, multiplier. Okay. See, I've already shared the concept, broader concept. What is the broader concept? Let me make you once again understand this. Multiplier basically means the multiple income, which is, okay, let's go for this graph, which will make you further understand. Sujal, just see the graph once. That will make things understand to you. Okay. So here, what do you see? This is a two-sector model. What are the two things we are taking here? In a two-sector model, you remember what we took? We took corporate and household. So here you see consumption and investment. I should take some other color. Okay. So here is the aggregate demand. This is aggregate demand, consumption and investment, aggregate demand. And what is this 45-degree line? This is aggregate supply. This is aggregate supply. Okay. And the point at which aggregate demand is equal to aggregate supply is equilibrium. So this is equilibrium. And what is the level of income? Income is Y0. Now let's say that investment increases in the country from I to delta I. I'll take another color. Okay. So investments in the economy increases from I to delta I. So this increase in investment here, this is the increase in investment. This is delta I. This increase in investment by delta I, you can see that equilibrium shifts from E to E dash. And income increases from Y0 to Y1. This is the level of increase in income. So by delta I increase in investment, income increases by delta Y. This is multiplier. What is multiplier? Multiplier is multiplier, which sometimes you see as M, sometimes they write it as K. One and the same thing, it is 1 upon MPC. You can calculate like this, or you can calculate K is equal to delta Y by delta I. Okay, so this is 1 and you equate this with 1 minus MPC. Now you can do any question, any numerical, because maybe possible they'll give you consumption equation and they'll give you change in income, but they will not give you change in investments. So you can find out through this. First you'll find out K and then you can find out. So this is clear. Sujal, is it clear? Multiplier impact is clear. Mansha, in the short run, investment is constant. Yes, you can see here. You see, investment is constant. Valid question, Mansha. But if you look in the lower panel, you can see here what's happening in the lower panel. Investments have increased. Investment initially was I, and now investment has gone to I plus delta I. But it is not dependent on level of income. That is why it is parallel to x-axis, isn't it? It is parallel to x-axis. So investments have increased over the period of time from I to delta I. And that is why you can see that income has increased from Y0 to Y1. And when you are at Y0, when investment is I, you are here at E. What about investments? What is the probability of investments here? If investment goes up, that means what investment leads to? Investment leads to, imagine a corporate going for investments. What's the outcome of that? Corporate going for investment means they are producing more. They are producing more means they need more people. Employment will increase. Employment increases, output increases. Disposable income increases. Disposable income increases means your purchasing power goes up. Your purchasing power goes up means you demand more, and national income of the country will increase. So that is why you see here increase in income from Y0 to Y1. This is multiplier. Investments over the period of time, which increases because of increase in investment increases that leads to increase in income, is multiplier. This multiplier is known as investment multiplier. So if you look today that India is working on Gati Shakti, if you've heard about Gati Shakti, they are constructing national highways, they are constructing roads, they are connecting ports, they are working on logistics. So because of this, what's happening? These are investments government is doing. Delhi Agra flyover. Because of that, so many people have got job. and how multiple income it has generated. So investments leads to multiple income. Okay, it can be by corporate, it can be by government. If it is happening by corporate, then in that case, government will go for investing less. But if corporate are not investing, then in that case, government has to invest. So this is clear. This is clear to all of you. Investment multiplier. Okay, so this is the concept of investment multiplier. If you look at the two panels here, what do you see in two panels? Savings, you know, savings are leakages. And investments are injections. If you are to the left of this E, if you are to the left of this E, left side of this, what's happening here? When you're transiting from E to E dash here, investments are higher. Investments are higher means corporate are optimistic about that economy will grow. We should invest. They are investing means output is increasing, employment is increasing. But if you see to the right of this, what do you see right of this? Investments are less, savings are higher. That means people are saving more. Saving more means they're consuming less. They're consuming less means they're demanding less. They're demanding less means inventories will be more. If inventories are more here, will the corporate produce? No, they'll not produce. Production will stop. Production reduces means output reduces, employment reduces, income reduces. So to the right of this, savings are more than investments. To the left of this, investments are more than savings. As long as investments are more than savings, economy will grow. And the point at which investments are equal to savings, that's the point of equilibrium. You can see in the upper panel also. So this is the point where there is equilibrium in the economy. Okay, E dash. So this is the concept of good. Just be it's clear to you, good. Okay, so this is the multiplier concept, savings and investments. I hope you understand. Please do remember always when we talk about equilibrium, we say that because you see aggregate demand is in a two-sector model is C plus I and Y is C plus S, or aggregate supply is C plus S. And if you equate aggregate demand equal to aggregate supply, that means C plus I is equal to C plus S. That means investments are equal to savings. That is the condition of equilibrium. And that is what you see in the lower panel here. At E, it is at equilibrium when the level of investments are I. At E dash, it is at equilibrium level, which is higher than E. Reason being here, investments have increased by delta I. So this is the concept of investment multiplier. There are many questions which have been asked in the question paper over the period of time. If you have gone through last year question papers, you might have seen many questions are asked on this particular concept. By going for one or two variables missing, one variable missing, so you should understand the complete equation here. Okay. So I have already shared in underdeveloped countries and developing Africa, the impact will be much, much higher as compared to India. One road constructed over there can go for multiple income generation as compared to India. The impact of multiplier will be higher in India as compared to US and other countries. Okay, so in underdeveloped countries, multiplier impact is high, but value is low due to lack of productivity. What happens basically? The labor and capital are not so skilled. So that is why value may be low, but impact is huge. So we need to work. That's why Government of India working on Skill India, training of people, new education policies, strengthening skill and caliber of people, holistic development, so that people should not be simply rote learners. That will help in increasing efficiency of labor and capital. We are opting for new technology that will increase efficiency and will make higher impact and value of multiplier in India. So this we have already shared. I've already shared with you people this. Increase in autonomous investment spending, delta I, will increase national income by delta Y. This can be represented as 1 by 1 minus MPC to delta I. This is represented as K. One more thing here. See, we have shared MPC plus MPS is equal to 1. Now, if I say that K is equal to delta Y by delta I, or 1 upon 1 minus MPC, I can also write it as 1 upon MPS. Yes? Because 1 minus MPC here is MPS. So you can write MPS also. Okay? So this is one the same thing. Now, what can be the maximum value of the multiplier? It can be infinity, because if MPC becomes 1, which is not possible, because you remember we had shared, Kin said that MPC will always be greater than 0 but less than 1. So if it is going to be 1, which is a remote extreme possibility, then in that case multiplier can be infinite, because 1 minus 1 will become 0. 1 by 0 is infinite. So this is the concept of multiplier. Okay. So for example, I've already shared, if 1 million increase in the total amount of investments in the economy will lead to chain reaction. And this will generate multiple income in the hands of people, which will lead to multiple spending. Multiple spending means multiple income, and so on and so on. It goes on. Okay. So the way we have shared 100 million investments, if MPC is 0.5, first round will generate 50 million, second round will generate 25 million, third will generate 12.5 and 6.25, and so on and so on. Okay. So this is the concept of multiplier. Now, we have already shared, in a realistic world, there are always some leakages which will stop this process of multiplier at some point of time, or it may slow down the process, which brings it to halt. What can be the reasons for leakages? That a graph will be given in exam and we are asked to, not exactly graph they give as such, they may give, see, anything is possible, you may get anything, you should be ready for everything. So you should not think about that graph. If graph is given, the concept is clear. If not given, you know the concept, you can make the graph. So it should be crystal clear to you. You cannot expect this. Apprehensions, I want to say apprehensions is about that future, you believe that growth will be happening. That is about apprehension. That you believe, like during COVID, apprehension was that about expectations, in a simple layman terms, expectations. What you expect, what you anticipate. Numerically, Karthik, it's clear to you, savings and investment is clear. What is practical meaning? Practical meaning simply means that if savings are more than investment, simply it means to say that you understand in a simple language, if household go for saving 100 crores and investment is only 80 crore, that means 20 crore is leakage. That 20 crore has not come back into investment back. And that 20 crore which is not back in the system, that means investment has reduced by that much quantum. And you understand that if investments are less, we have shared the multiplier impact. Lower and lower investments, lower will be the multiplier value and impact of it. And lower will be economic growth, because in the end, investment leads to what? Growth of the economy. So if investments are less than savings, that means there are leakages. And these leakages are resulting in low increase in the level of income. That's the implication, Karthik, okay? How can aggregate demand and saving curve goes up at the same time? Yes, valid question. Aggregate demand is about what? Demand when the consumption increases. Okay, consumption increases, then in that case, aggregate demand will increase. Now, saving curve is going up because aggregate demand is going up and saving curve is going up because these two curves are dependent on income. And you see on the x-axis, we are taking income. So if income is increasing, savings should increase, consumption should increase. Okay, so Mukta, is it clear? Okay, so what are the components of leakages? We have shared that this growth cycle of investment multiplier can get halted because of, can get stopped because of certain components of leakages. So what are the components of leakages? If suppose people go for more savings, okay, if savings are more means consumption is less. Consumption is less means demand is less. Demand is less means why should corporate produce more? They'll produce less, and they produce less means they'll create less jobs. Less job means low income in hand of public, and low income leads to further decrease in the national income. So if savings are higher pace as compared to consumption, that leads to leakages. Okay. Progressive taxes. You understand what is progressive taxes? Progressive taxes means as income increases, tax rate increases. Now, imagine if income increases and simultaneously tax rate increases. What happens? Your marginal propensity to consume will increase or will remain same? Will not increase because the tax rate has gone up. So if the tax rate increases, progressively the tax rate increases, then in that case, the impact of marginal propensity to consume will be at a lower pace. And that will reduce income in the economy and the impact of multiplier. So progressive taxes adversely affects multiplier impact because we have shared consumption is a function of, please do remember this, we have shared that what we have shared that consumption is a function of, is a function of disposable income. And this disposable income is Y plus TR minus taxes. Now, if this goes up, then this will go down. This will go down means consumption will go down. And if consumption goes down means corporate demand will be less of goods and services. Their demand is less means they'll produce less. Okay, so progressive taxes results in reducing the impact. High liquidity preference. High liquidity preference means what happened during COVID? People wanted to keep more cash. So if you keep more cash and you are not spending, you're keeping more cash, then in that case, MPC will be lower. And since MPC is lower, multiplier impact will be lower. Because MPC is the factor which drives multiplier, isn't it? So high liquidity preference. So during COVID, you have seen people were scared about that we will not have job. So let's not spend more. Let's go for saving more. If job will not be there tomorrow and we need money, from where will we get? So people were scared. So they were not spending. That means they were keeping more cash. So liquidity preference. Leading to less spending. Less spending leads to low MPC. Okay, so again, leakages. Then excess of inventory investments. So corporate thought about that people will demand more, and they have gone for surplus investments. But overall demand is less. What will happen? Inventories will be piled up. And since inventories are piled up, they'll not go for further production. They won't go for further production means they will not create income. They will not create income means it will affect MPC. So excess inventories leads to low job opportunities. Low opportunities means less disposable income. Less disposable income means less consumption. Less consumption means less MPC. High reliance on imports. If a country has high reliance on imports, means we rely more on imports than we export. What's going to happen if we rely more on imports? That means you are not creating enough job in country, no? If you go for more imports. If you are exporter country, then you create jobs. If you create jobs means you create income. You create income means you create consumption demand. But if you are going for imports, that means you are importing from the other country, you are not producing in your home country. That is why you are not hiring more people, you are not hiring more people, they are not getting income, they are not getting income, they are not consuming, they are not consuming. That is leading to low MPC. Okay, then investment in existing financial products. So you go for putting your money in shares, bonds, government securities. That means there's no circulation of money, no? You have purchased those bonds until unless those financial instruments are further going to get invested in projects where it generates multiple income, then it is fine. Okay, so you are investing in shares, and that quantum of money by the company which has issued shares is using it for expansion of the firm, new technology. Definitely it's going to generate. But if company has taken money from you in terms of shares and they are meeting their liabilities, some debt obligations, then in that case, it is not going to generate income in the country. So again, it is leakages. Okay, high debt obligations. High debt obligations, more loan. You have to pay loan payments only. Loan payments you have to pay, you already have high level of debt obligations. That means you do not have enough money to spend. So your spending will be decreased because you have to settle your debt obligations. High retained earnings of corporate. Retained earnings, you understand, retained earning means corporate are not passing on as dividends to the shareholders, and they are keeping it with themselves, that money. If they invest that money in expansion, then it is fine. But if they are not investing anywhere that money and using it for their own company's admin expenses or others, that means it is leakage. Then scarcity of supply despite high consumption demand. In India, you do not have enough production capacity. So despite having high consumption demand, if you cannot meet the demand to that extent, that means again it will lead to leakages, or rather it may lead to more imports. So that is also leakage. Then economy, if it is at full employment, this is more hypothetical in the case of developing country like India. So if economy has full resources, fully utilized resources, land, labor, capital, and entrepreneur, then the increase in demand will lead to inflation in the economy. We have shared inflationary gap. That's the concept. So these leakages, you should understand. We should understand the implication of this. We should be able to justify that in which case the impact of investment multiplier can be less. Okay, so this is the concept of investment multiplier. So this is one of the questions given in your book only. High debt obligations will also generate interest income, but you understand that interest income is very less as compared to debt obligation settlement. So that income, yes, the income which is generated will definitely be, Karthik, used as injection. But debt obligations, if it is higher and higher and you are paying interest on that debt obligations only, then in that case, corporate will be adversely affected. Economics more interesting and more understandable. So, okay, so this is about the concept here. Okay, so it's clear. So you look at this here. One question given is, in an economy, every time income rises by 75% of rise in income is spent on consumption. That means what? What is this 75%? This is MPC. Rise in income is spent on consumption. So 75% means MPC is given to you 0.75 in this case. 0.75 is MPC. If the investment in the economy increased by 750 million, so what is given to you? Find change in income. They're asking change in income. We have studied that K is equal to 1 minus MPC. It is also equal to delta Y by delta I. Okay, so in this case, you have to find out change in income. You have to find out delta Y. Now this you know, MPC you know is 0.75. You have been given investments, that is 750 million here. So what is your equation now? 1 upon 0.25 is equal to delta Y you have to find out, and delta I is given to you 750. So you can find out the value of delta Y here. That will give you change in income. What's the answer for change in income? You can find out change in income here. Similarly, change in savings. So once you have change in income, then you can find out savings. Okay, because MPC gives you what? MPC gives you consumption. So find out what is the level of income. This is 750. This is 1 by 0.25. So you can calculate 750 by 0.25 is equal to delta Y. So 5,000 delta Y. 25, no, 3,000, I'm sorry. 3,000. Okay, so 25, 3 is 75. And this is the value. So delta Y is 3,000. So this is how you can find out. Once you have delta Y, you can find out consumption. 75% is consumption of 3,000 and rest will be savings. Okay, so this is how you can find out. Now, suppose if they give you saving function, if saving function is given, so this is a saving function. Now, what is this A here, the saving function? What is this? What is this minus 10 here? Minus 10 is, you remember in consumption function, we had written A plus B by D. And you know that aggregate demand we had defined as consumption plus investment. You can write aggregate demand is equal to C, that is A plus B by D plus I. And if you equate this aggregate demand to aggregate supply, you can write Y is equal to A plus B by D plus I. This is aggregate demand, this is aggregate supply. We are equating these two. Now this, here they have given you saving function. Can you convert saving function to this consumption function? This minus 10 can become 10. This is 1 minus b, that is, it is 0.8 yd. Y plus I is given 50. You can find out the value of y here. Y is the only unknown variable. You can find out value of y. You can find out consumption. Once you get this, you can find out consumption by substituting in this value of y. Because there are no taxes given, no transfer receipts given, so yd will be equal to y only. You can find out this. Yes, solutions are available. Don't worry. It is there. Yes, change in savings is 750. Are the answer back questions, so all answers are given in the book itself. Study material, you can check. Otherwise, for all revision question papers, all answers are given. You need to practice. ICI also given you ready reckoner also. So all formulas are also given, which are readily handy for you people. You just have to go through ICI portal and see everything. Board of Studies is doing so much for you people. You people have to go through all those content thoroughly. So I'm trying to cover all concepts and some numerical. If time will permit, we'll do some numerical also. Because first and foremost, it's important for you to understand all the concepts. If you will not understand concept, you can see the very first page of study material and examination feedback of the examiners, that they always look for application. An application you can only can do it if you know the concepts thoroughly. So it's very important to understand concept. So this is clear how to get this question. How will you do this question? Now they are asking here about multiplier. So what are the things they are asking you? We are doing one question and then you can do yourself. Find the level of equilibrium, level of income, consumption, and if investment increases by 5 crore, find the new level of income and consumption. So first you find out income. How much is income here? You can find out income. Income is 300 crores. Okay. You can calculate this. You will get income as 300 crore. So once you get income as 300 crore, then they are asking you for income, consumption. Then you have to find out consumption. So you can find out consumption by substituting in this equation. So that means consumption is equal to 10 plus 0.8, 300. This will give you consumption. So you get consumption as 250 crores. Once you get consumption, you know income is 300 crores. Income minus consumption is savings. So you have calculated, you have already have income, you have consumption, you can get savings. So savings will be how much? 50 crores. The saving will be 50 crores. Once you have got this income, you have got consumption. If investment increases by 5 crore, find the new level of income and consumption. If investment increases by 5 crore, investment increases by 5 crore means they have given you what? Delta I. Delta I, they have given you 5 crores. You know MPC in this question. MPC is given to you 0.8. You know multiplier, how to calculate multiplier. Multiplier is K is equal to delta Y by delta I, or it is also equal to 1 upon 1 minus MPC. This is given to you 1 by 1 minus 0.8. That is 1 by 0.2. That is 5. So multiplier, you have got 5. Now you can calculate. Multiplier is given, 5 crore is given. You can calculate income. How much will be the income here? Income will be I'll use different color to make you understand. So the level of income will be how much? You know K is equal to delta Y by delta I is equal to 1 upon 1 minus MPC. That is 5. This is 5. Now you know delta Y is how much? Delta Y you have to find out. And delta I they have given 5 crore. So this you have 5 crore, this you have 5. 5 5s are 25. That means 25 crore is delta Y. Okay, so this is how you can solve it. Is it clear? 25, see, 25 crore here. I've solved this for you, and I believe it is solved in the book also. So you can find out this. This is a solved question. I've solved it here. 25 crore you have got, and then total income will be 325 because initial was 300 crores, and consumption will be change in income. So 25 crore into 0.8 will be increase in consumption. So 25 into 0.8 is 20 crores is increase in income. Yeah, Shinjini, right, 300 crores. Yes, you're right. Absolutely right. Sujal, absolutely right. 25 crore. Yes, Mukta, right. Very clear. Okay, good. Okay, so this is how. Ang Angshil, your answer is not correct. Delta Y is not 10. Delta Y is 25. 5 5s are 25. No, multiplier is 5 and investment increases by 5. So that comes to 25. Okay, so this is how you calculate. We have done multiplier concept. I have taken care about one question, also 2 or 3 questions. I hope you can do it yourself now. If you are stuck, then just let me know. In the next class, we'll devote some time for national income accounting questions as well as this chapter numericals also. Because in future, in money chapter, money demand and money supply, you have numericals. And prior to that, it's all theoretical concept based. So we can devote some time in the next class for numericals also if you have some queries related to that. Okay, now. So we are talking now, we have been discussing till now about two-sector model, that is household and firms. Now we want to add up here the third component, that is government. Okay, so now we are going to talk about three sector. So over there we talk about investments are injections, savings are leakages, isn't it? So over there we took savings and investments as injections, savings as leakages and investments as injections. And consumption is the driving force for any economic growth. Okay, so that's very important to understand that consumption drives economic growth. If consumption is not there, then why should producers they produce? And that is why MPC plays very important role. Now, next we are talking about three sector model. So if you first you understand the basic of the three sector model before we go ahead. Now this is given in your book. If you have referred to your book, you might have seen this. This is a three sector model. Now three sector model, when we talk about, you can see here, we have added the third component as government. So this is the third player. We had business, we had household, now we have government also. Now how the transactions have changed because of entry of government here. So you can see here, households, they pay taxes to government. Taxes are what? Taxes are leakages. Why leakages? Because it reduces income of household. If household income reduces, means their consumption demand reduces. So taxes are leakages. What about transfer payments? Government give transfer payments to households. These are injections. So transfer payments are injections that increases income of the household and they can spend more. So that adds up to their household's income. YD goes up. And here YD goes down. So these are injections. Okay. What about here? Business taxes. Business firms have to pay taxes to the government and government gives them subsidies. Through taxes, what government gets income, that income government goes for taking care about purchasing of goods and services. So you see here purchase of goods and services. The government purchases goods and services from the product market. Okay. And households, what do? They go for consumption expenditure. They consume, they demand. Government purchase, it creates demand. And who takes care about this demand? Corporate. You see, corporate, they go for goods and services. So corporate, they provide goods and services. Corporate, they spend on products and services. Expenditure, they incur expenditure. From where do they get this money? They get this money from consumers, from government, where they spend. So money comes back here. Apart from that, households, they go for savings. Households, they go for savings. Where do they save? They save in financial market. And through financial market, business firms, they borrow. They borrow and they invest. That is the point here. If this savings is equal to investments here, then you are at equilibrium. So they go for savings, households, they go for savings. Firms, they borrow from financial market. They borrow and they invest. They invest in production of goods and services, machines and technology. Then it comes back to the system. So this is injection. This is injection. Now, households, they render their services to whom? In the terms of factor market, factor services, they give factor services. And businesses, they take their services. So factor services are taken by whom? By business units. And in return, what do? They pay them. Business firms, they pay to factor market. They get income, their disposable income goes up. Disposable income goes up. They spend. They buy goods and services. They produce, they invest and they produce. And these goods and services are given to whom? To households. This is a three-sector model. So what are the changes you have found here? There's a component of tax, there's a component of subsidies. Government also goes for borrowings to meet its debt obligations. And from where do they meet this? They meet it through households and business units because they put their money here in financial markets. So basically, households, they put their savings, and if these savings are used by government also, by corporate also, if savings are utilized here, well and good. If not, then it becomes leakages. Okay, so this is the concept of three-sector model in the economy. Okay. See, it's not about number of points you write. Nobody is going to give you marks just by writing points, by counting 1, 2, 3, 4. It's about content. If you write 2 points all useless, you will get 0 marks. You write 7 points all useless, you will get 0 marks. You write full page without making sense, you get 0 marks. If you write half a page, which makes sense, you will get marks. So it's not about how many points you're writing. It's about what you're writing. That is important. Okay. Yes, subsidies are leakages, Hitesh. Till the time those subsidies for the government, it is leakage because it leads to what? It leads to government more expenses. And if those expenses government has to incur by more borrowings, that means government will not be able to channelize for investments. So subsidies are restricting government to go for investments. And you understand, if investments are less, then income generation in the country will be less. Okay, so three sector model, I hope is clear to all of you. So what is the extension we have done in three sector? What we have shared till now for two sector, we were talking about that AD is equal to P plus I. Now we have added plus G. That is aggregate demand, which has another component, government. Aggregate supply, we took care about P plus S. Consumption and savings, we add now taxes. Okay, so now in aggregate supply, three sector model, you have consumption, savings, and taxes. In aggregate demand, you have consumption, investment, and government expenditure. And if these two are equal, that means this consumption will cancel out. So basically, investment and government expenditure should be equal to savings and taxes. If government expenses are equal to taxes, then it will be nullified, no? And if investments are equal to savings, that means whatever savings are creating leakages as such are resulting in injections. So these two will be equate, and that will lead to equilibrium. So that is what equilibrium is all about. Leakages equal to injections. Government expenses increases national income. We have already shared that. Government expenditure leads to multiplier. So we have shared investment multiplier. Similarly, government expenditure is also multiplier. Investment by corporate, we have shared. Similarly, government expenditure. So you see Larsen and Toubro doing investments in India. You see metro railways has created so many jobs. Not only job for those who are driving that metro, but you see metro stations today. How many people have got job because of that? So it creates multiple income. Investments create multiple income through government expenditure multiplier also. So we have done investment multiplier. Now we are going to take care about government expenditure multiplier because we are talking about three sector model. So you can see this graph here. If we take this graph, you can see here what are we taking. I've already told you that now income has three components: consumption, I'm sorry, okay. So you can see here, this is about consumption. Consumption, savings, and taxes. Okay, I don't know what's happening. Anyways, okay, so consumption, savings, and taxes is aggregate supply. Then you have consumption, investment, and government expenditure. That is aggregate demand. Okay, and then you have consumption and investments. What do you see here? As government expenditure increases, the equilibrium moves from E to E dash. And what happens in the lower panel? So income increases in the country from Y to Y1 because of government expenditure. And what happens in the lower panel? If investments and government expenditure increases, as long as you are to the left of E1, that means investment and government expenditure are more as compared to savings. This will increase income in the country from Y to Y1. Concept is same. Only thing what has changed here is that rather than investments by corporate, we are talking about government expenditure. So this is known as government expenditure multiplier, which leads to increase in income in the country. Government multiplier. So this is the another model which you should know about. One, we have shared investment multiplier. Second is government expenditure multiplier. Okay. So this is one of the questions given over here. This is from your book only. Now you have been given consumption function. Can you see consumption function? Absolutely, Jaspreet, it's only about quality. Yes, you're right. Mansha, autonomous investment motivated by social welfare, whereas induced investment motivated by profits. Autonomous investment is something which is not dependent on income. Autonomous, if you talk Mansha, autonomous investments are not dependent on income. Induced investments are dependent on income. You're right, by which drives through the profit. You gain more profit, that motivates you to go for more investments. You're right that way. Okay, why the direction of arrow of expenditure on domestic products is going to the businesses in the diagram you just thought. Okay, Mukta, meaning of leakages and injections. I'll share once again, Mukta, leakages and injections. Leakages, when we talk about leakages, which reduces the impact. See, we have said that consumption is the driving force of any economy. Consumption depends on what? Disposable income. Disposable, Mukta, you understand disposable income. So disposable income depends on what? How much income you have, what kind of tax rate you have been imposed on, and what kind of transfer receipts you're getting. Now, if tax rate goes up over the period of time, what happens? Your income decreases. Your income decreases means you consume less. You consume less means you demand less. You demand less means corporate, they produce less. It's a leakage. If you go for savings, you're saving more. That means you're keeping money aside. You're not spending. You're not spending. You're not creating demand. You're not creating demand. That means it is leading to leakages. What about injections? Injections are when you go for investments, which generates multiple income. When you go for exports, which generates income. Rather, when you go for imports, then in that case, you're not producing in your home country, you are importing from others. It is leading to your money going from home to the other country. That is leakages. Okay, Mukta. T stands for tax. Actually, T stands for tax. Okay, so why disposable income? What is disposable income? Income minus taxes. Lump sum tax. See, there are two categories of taxes. One is a lump sum tax which has to be paid. Other is that tax which is dependent on the level of income. Okay, so we will be sharing that later. But in this case, we are only talking about lump sum tax. So we have already added the component here in a 3-sector model. What are the 3 components we have added? 3-sector model. This was the initial consumption function we took care about. And in 2-sector, we added what? We added I. And in 3-sector, we are adding G, government expenditure. And this YD is disposable income. This disposable income is Y minus taxes. Okay, so this is your equilibrium condition because Y is aggregate supply and these are the components of aggregate demand. So aggregate supply equal to aggregate demand is equilibrium. So this is what you have to remember. Now we are talking about three-sector model. So your three-sector model is C plus I plus D is equal to aggregate demand. And it is equal to Y aggregate supply. This is a three-sector model. We have G also component, government expenditure component also here. And since government is there, then tax also has to be included. Because government, you have seen that government goes for imposing tax. So the tax component is added here. Okay, so if the question given to you is that they have given you consumption function, they were given you investments, they have told you that government expenses is equal to tax, that is 20. Now you have to find out equilibrium level of national income. How will you find out equilibrium level of national income? You'll say Y is equal to C plus I plus G. And C is given to you what? So Y is equal to 10 plus 0.75 YD. YD is Y minus T. So you can take it as Y minus T. Y minus T is how much? Minus 20. So you take it as Y minus 20. Okay, so I'll write it again here. I'm not able to find eraser. I'll write it again here. Okay, you can see this. Y is equal to P plus I plus G. And Y is 10 plus 0.75. YD you can write as Y minus 20 plus I is given how much? 50 plus G, I is equal to 50 and G is equal to 20. So G is 20. This is your equation. Once you have this equation, Y is the only missing factor. You can find out the value of Y. That will give you national income. You can calculate how much will be the national income. I've already written the equation here. Only factor missing is here Y. You can find out the value of Y. So you will get first part of the answer. Second part is size of the multiplier. You know how to calculate multiplier. Multiplier is K is equal to 1 minus MPC. What is MPC here? MPC is 0.75. 1 minus 0.75. That is 1 by 0.25. That is 4. So multiplier is 4. Yes. Absolutely, absolutely, Mukta. Leakages are opposite of injections. Yes. Okay. So this is the concept of size of multiplier. You can find out the value. Did you calculate? Anyone has calculated? Anyone has calculated the value here? What is the value of national income? You can calculate. I've already shared equation with you people. Okay. Amshil has got, Harsh has also got 260. Yes, it is 260. I hope you have not referred to the book and you have calculated yourself. So value of equilibrium is income is 260 and multiplier is 4. Okay. Now we'll take a break and then we'll start with the next concept after 10 minutes. Take a break and let's start after 10 minutes with the concept because it will become otherwise. I can see some of you saying it is too deep. There are so many concepts to understand. Okay, so let's take a break for 10 minutes and then resume after 10 minutes. Okay. Okay. So Sahil always, as usual, have grudges and his query, I'm taking it, which is not making sense at all, but still I'm taking it. So see, he's asking for business to product market. Now, in this circular flow market, you see, we have already defined the concept of product market and factor market. Product market is the market where goods and services are produced by the firms and they are purchased by household. So you can see here businesses, they go for production of goods and services. So it has to be from the firms to the product market only. And then further, if you see, the goods and services are purchased by household. So the arrow is perfectly right. There should not be any confusion regarding the sequence here, because until or unless you know the concept, then only you can understand. So you should be able to differentiate between the product market and factor market. Product market is where goods and services are produced, and factor market is where factors of productions are rendered their services, and in return they are paid factor services. So these two are the real flow, and we have already shared in the last class. So those who were attentive, I hope they are clear with it. Those who didn't pay attention, that is why they are having query this time to get the concept. So I hope it is clear now about the directions with respect to business of firms. They produce goods and services by investing, getting the money from the financial markets. Because of the household sector, they go for saving. So this we have already discussed in detail. And I don't want to waste further time on this. Okay, so we were discussing about government, and I want to take query of one more student here wanted to ask about autonomous increase in government spending generates income more than autonomous increase in investments. Mancha, it is both ways true that when investment increases by the corporate, that also leads to more income generation, and autonomous increase in government spending also generates income. So it depends upon where the government is spending and respectively where's the demand for that. For example, you see metro, you see flyovers, you see the railways connectivity, all those issues. In terms of investments, yes, definitely it helps. Okay, so we have already discussed these concepts. Okay. Yeah, Karthik, you're right. Okay, so this is the concept. Okay, so now let's go for taking care about the tax, which we have done in a simplified form. We have taken only in terms of lump sum tax, isn't it? But you see that as the income slab increases, the tax rate increases. So the tax is also related to the level of income. So there are two components of tax. One is the lump sum tax, and the other is the tax which is based on income. That's why you see as the slab changes, the level of income, with the change in the level of income, the tax rate changes. So you'll see the modification in the tax function now. Okay. So we have already done this 260. Now you see there are two components of taxes. First and the foremost, this is a simple one which you understand here. This we have already taken care. This you understand. This is disposable income. This is Y. This is tax, lump sum tax, and this is transfer receipts. So the concept is same. We have already done it, and you understand this is 1 minus B is what? This is the way B is what? B is MPC. So this is about investment multiplier. Similarly, you can calculate the government expenditure multiplier also, that I'll share later. But I want to discuss something related to this one, tax function here. This tax function has two components. Do not get confused with this T and this T. This T should have a bar on it. So this is a constant one. Okay, this is a constant one. And this is the function of income. So as you see, slab goes up and respectively the tax rate goes up. So this is a constant tax which is imposed, and this is lump sum tax, and this is which changes with the change in income. So this is a new tax function. I hope you understand. So when we go for now onwards, when we'll say YD, when you go for YD here onwards, what will you do? You will go for taking care about Y minus this tax function. Okay, so you have to substitute this entire tax function here. That this is what you have to remember about. So this is about T plus this is which one? This is about the lump sum tax plus this is about the tax rate which goes up with income. I'm sorry for this. I'm sorry. Okay, so this is how it goes. Okay, so do take care about when disposable income we are talking about henceforth. So you have to see which question they have given, what components. Accordingly, you have to modify your calculation part. Okay, so here you can see. And this question, what do you see here? You see this one. Can you see this tax function here? What is this 25 here? This is lump sum tax. And what is the 0.1? This is the tax rate with respect to income. So this is a modified tax function given to you. Now, if they have given you this here, consumption function, investments, and tax rate, and government expenditure, they're asking for equilibrium, so you can easily calculate equilibrium. You know the fundamental rule of equilibrium. Equilibrium can always be achieved when aggregate supply is equal to aggregate demand. And this aggregate supply is nothing else than Y is equal to C plus I plus G. And this C has now modified because you know how we write YD, isn't it? BYD. And now this YD has component of this plus I plus G. So this tax function has to be incorporated here. So this is the equation of equilibrium. You know the concept of multiplier. Multiplier will be 0.5. This is 0.5. So multiplier, you know, K will be equal to 1 minus MPC. MPC is given to you as 0.5. This becomes 0.5. This becomes 2. So multiplier anyways is 2. That's very simple in this question. But only thing equilibrium you can find out by substituting the values here. This is also given. And I hope you can calculate here. Okay, so this is how you will calculate. Your answer should be 440.91. Just check it once. Okay, multiplier, one thing. Okay. See what you have to take care here. We are talking about tax multiplier because we have included tax, no? And because of tax, what happens? YD decreases. Okay, so you have to take into account this tax also. So your multiplier now after tax will be 1 upon 1 minus B, 1 minus T. This is how your multiplier will be when the tax is given to you. If it is a lump sum tax, then it is okay. But if it is about function of income, then you will take this. Okay, that's why rather than having value of 2, now multiplier value is 1.82. So one of you were asking about leakages. You can see here because of the tax rate, the value of multiplier has decreased from 2 to 1.82. So here there's the leakage of this 2 minus 1.82 is leakages because of the tax rate imposed here. Okay, so this is clear. So what you have to remember when we include tax, okay, what is the difference between tax and lump sum tax? See, lump sum tax is the tax which is given, which has to be paid in one go, irrespective of the income. And the tax rate, which is dependent on income, as your income increases, the tax rate increases. So that is about the tax component, which has to be accommodated here. Okay, so this is clear. Multiplier. So what you have to remember? You have to remember, in the case of investment multiplier, when you have investment multiplier, how do you calculate? Your K is 1 minus MPC or 1 minus B. But in the case of tax multiplier, since your disposable income decreases, your K becomes equal to 1 minus B, 1 minus T. Do remember this always, please. This is a new form of tax multiplier. So this is how you'll take care about tax multiplier. And you can see the difference here. When we calculated by 1 minus B, K value was coming 2. And now K value is coming 1.82. So the multiplier impact here is less because of tax rate. And we have shared tax rates act as leakages. So tax is a leakage here, which has resulted in lowering down the value of multiplier. Okay, so this is how, see, you can connect the concept. What we are sharing is not just for the sake of it, it is actually happening here, isn't it? So this is clear. Government transfer payments and its impact on income. Obviously, if government transfer payments are equal to the tax rate, then this will be nullified, no? Your disposable income will remain one and the same. If the transfer receipts are equal to tax, then in that case, your disposable income remains same. But if taxes are higher than transfer receipts, definitely it will have impact on your disposable income and your MPC. So this is what is important for you to understand. So the formula and size of expenditure multiplier is always determined by the particular model of expenditure sector. Which one you are using? Are you using investment? Are you using government expenditure? Are you using government? In the case of government expenditure, the multiplier remains same. But if the tax component is added, then the multiplier will change. So please do remember, when we talk about investment multiplier, your investment multiplier will be 1 minus MPC. When you talk about government expenditure multiplier, it will be 1 minus MPC. When you talk about tax multiplier, then it will be K is equal to 1 minus MPC, 1 minus T. Okay, so this is how it changes. So these are the three fundamentals which you have to remember when you talk about multiplier concept. Done? Is it clear? So once you know the concept, you can solve any question, any question. And please do make a habit of writing inferences. If you write inferences, nobody is going to ever deduct your marks. And inferences you can only draw when you understand concept. The concept clarity is very, very important. Once you know the concept, you can solve any numerical, any numerical. The way we had done in national income accounting, similarly over here. So there are only a few concepts which you have to remember. What is YD? What is the identity? How do you express YD? How do you express multiplier? How multiplier varies from investment to government to tax multiplier? Then how the basic equation changes from 2 sector to 3 sector. So from 2 sector, aggregate demand and aggregate supply is equal to C plus I is equal to C plus S. That is how we have taken savings and injections and leakages. And similarly, when you go from 2 sector to 3 sector, then you have government, and government, since government is there, government goes for expenditure also, government imposes taxes also. So you have two sides here. You talk about savings, you talk about taxes, you talk about the component of savings, investments, and taxes, and over there you go for government expenditure. So this is how you go for differentiating here. Okay. So if government expenditure If government expenditure increases by 5%, tax rate increases by 5%, that means disposable income will remain unchanged and that will not make any impact. So you can simply go for taking care about 1 upon 1 minus MPC because there's no impact of tax, no? Now in the four-sector model, what will be in the four-sector model? We have taken care about which components? We have taken care about components of government. So we moved from consumption, that is by a household, along with corporate. Then we moved to government, and now we are taking care about rest of the world. So what you see over here is rest of the world, because in today's context, you cannot say that country is working in silo. You have to work as per rest of the world transactions also. You go for some imports, you go for some exports, you go for investments abroad. You tell foreign players to invest in your country, you welcome them in India. At the same time, you borrow from rest of the world, and other countries also, they borrow from you. So these are multilateral transactions which happens with the rest of the world, and it makes impact on the economy as a whole. Okay, so when we talk about here four-sector model, so basically in four-sector, we will talk about export and imports and trade multiplier. Okay, so trade multiplier will be the next component which we will be sharing. Now you can see here we are talking about rest of the world. We already had business, we had government, we had households. We have already shared business, government, household, and financial market transactions. We have shared this. Now we are talking rest of the world. How rest of the world interact here is going to interact here. So people go for imports from the rest of the world. Rest of the world goes for export to India. If they export, they add up to product market. We go for buying goods from international market, that's about imports. Apart from that, there is some capital inflow in the country, and there's some capital outflow also from the country. So if you see this net capital inflow is going from rest of the world, where is it going? It's going to the factor market. How come it is going to the factor market? So for example, I say that Infosys in India wants certain employees of Infosys to work abroad on some assignment. They go abroad, they work over there, they bring proceeds back to the country, because these are factors of production. They are rendering their services and they are bringing money back home. That is plus. That's why you see here it's written net capital inflow. Net capital inflow means what is coming to the country in terms of forex and what is going out of the country. It may be in form of investments, it may be in the form of, because you know factors of production are land, labor, capital, and entrepreneur. So it can be in terms of profit, which is coming back. It can be in terms of investment proceeds, which are coming back. It can be in terms of salaries, people are bringing it back home. Profits, they are bringing it back home, and vice versa. So the net is calculated here. That is how rest of the world interaction is there. Similarly for exports and imports. If our exports are more than imports, that means it's injection for the economy. And you understand success of China. China's success was only because of exports. So they became super economic power in the world market because of this exports. Over the period of time, they became export hub. Any product you name in the world has some Chinese component because of their excellence in exports. And you can see in India, we are facing problem in solar panel and other things, solar cells and others, because of this imports. We have seen how rupee has got adversely affected because of oil import reliance. So these are injections, these are minus. Similarly, if net capital inflow is positive, that's injection. If net capital inflow is negative, That's leakages from the system. And you understand why this arrow is going from rest of the world to the factor market? Because who are giving those services? Factors of production, land, labor, and capital and entrepreneur. So Walmart invested in India. They have invested on Indian land. They have hired Indian people. That is bringing money to country, jobs to India. Similarly, Amazon in India, Walmart in India, Uber in India. That's all inflow. Similarly, Indians going for investing abroad, is they are investing abroad, but if they bring it back home, definitely plus. Okay, so this is the concept of rest of the world. So what we will be sharing is about trade multiplier. Okay, so the concept is clear. Illustration number 13. Okay, illustration 13, what is there in that case? Illustration 13, Kaveri, what is your problem in that? The equation remains same. Equation is about what? Multiplier we have already shared. What is the concept of multiplier? Is about, they're asking two things here: level of national income and the size of multiplier. So national income, how do you calculate national income? Simple rule you remember for three-sector model. For three-sector model, Y is equal to C plus I plus G. This component of C, you can write as A plus B YD plus I plus G. Now, variation can be there in YD. It can be A plus B Y minus T minus TY plus I plus G. Or it can be simply A plus B Y minus T plus I plus G. And left will be Y only because this is your aggregate supply. Equate these two. So only unknown variable in any case will be Y given to you. This will be given to you. You can find out Y. So just find out Y. You will get the value of 260 here. You've got 260. All of them have got majority of the people. Just do it once again, Kaveri. You will be able to solve it. Okay. So this is good. So we are sharing now tax multiplier we have done. We are sharing trade multiplier. Okay. So what is trade multi? Now you see the equation four-sector model. We have redefined four-sector. What is the four-sector model? Four-sector model, we have Y is equal to, that is aggregate supply, is equal to consumption, investment, government expenditure, net exports. Exports minus imports. So these are the components of aggregate demand. This is aggregate supply. Now you see here consumption is A plus B Y minus T. So here we are taking lump sum tax. Now here import function, this is import function. In this import function, you see one is absolute autonomous import. Autonomous import means this is not dependent on income. But this small m import depends on income. Like the way we define tax function, tax is T plus Ty. So this tax rate is dependent on income, but this tax is autonomous tax, which is not dependent on income. Similarly, this import is not dependent on income. This is dependent on income. So these are the two components of, this is known as marginal propensity to import. Marginal propensity to import. This small m is marginal propensity to import. What it means? That what is with an additional income of 1 rupee, how much you want to spend on imports. That is marginal propensity to import. You understand, if marginal propensity to import is higher, that means national income of the country will increase or decrease? Definitely decrease, isn't it? So marginal propensity to import has a negative impact. Higher and higher reliance you have on imports, lower and lower is your national income, because it's a leakage. But if this will be exports, definitely it will be injection. So this you can see here, this is the basic equation. Only what we have done in this m, we have substituted this m by this equation, import equation. So you can calculate foreign trade multiplier. What is foreign trade multiplier? This is 1 minus b plus m. Plus m. And definitely, because this becomes what? This is foreign trade multiplier. And that was the success of China. What it means? It means change in exports and change in national income. Change in exports and change in national income is foreign trade multiplier. And how do you write it? 1 upon 1 minus b. B is what? MPC. And minus m is marginal propensity to import. Lower and lower marginal propensity to import, higher is the impact in terms of increase in income. So this is foreign trade multiplier. And this is the success of China of gaining. Vietnam, China, these countries have gained a lot because of this foreign trade multiplier. Country which will have higher marginal propensity to import will definitely be on the lower side of this. Okay, so this is the concept of foreign trade multiplier. So I'll go for yes, absolutely right. Autonomous imports for India. Karthik, category of imports which are not dependent on income of the country, which you are bound to go for import, is certain category like fertilizers. Fertilizers, India is importing irrespective some imports which are inelastic in nature. Inelastic means you may have higher income, you may have lower income, but definitely that is a basic requirement for agriculture to have. If you cannot produce by your own, so if you're not having enough fertilizers to cater to Indian farmers, then you have to import fertilizers. And you know, because of this Ukraine-Russia crisis, we were importing a lot fertilizers from Ukraine, and we have suffered a lot because of this. So autonomous imports are something which are essential for the country, which are not co-dependent on income. But certain categories of import, which you go for buying more and more specific with increase in income, where those are not so much of necessity, but it leads to better quality of life. And so let's say that today India can go for better technology to make to create a defense equipments. It's because of the level of collaboration, the level of income we have today. We can afford to have our own submarine and so many other things today by importing technology because of the factor. So this is how it is changing. Okay. Net factor income. Yes, Tanvi, yes, you're right. Yes, exports are injections. Yes. So after the class, can you please explain the formulas relating it with practical market, like of aggregate demand? Formulas relating it with practical market, if you want to say, Karthik, I'll give you one simple example of MPC, HUL in India, Unilever in India, Nestle in India, Amazon in India, Uber in India. Why they are all here? Because of high MPC. Apple in India is because of MPC, isn't it? So Indians, more youngsters in India, their higher marginal propensity to consume, creating more demand. That is why Apple has established its unit in India. So that is, MPC is the core component. India is a consumer-driven country. And this consumer-driven country is making many players to invest in India. On the other hand, if you talk about foreign trade multiplier for China, because of their export competitiveness, Malaysia, Vietnam, because of their export competent, they could get multiple income generated through exports by contributing in value chain by iOS, by China. They could contribute in foreign trade multiplier in multiple income. For investment multiplier, I've already shared government expenditure multiplier in India, government expenditure multiplier because of so many factors, hospitals in India. Then you talk about Gati Shakti is very good example. Ports in India, the way government of India is working on ports, government of India working on flyovers, government of India working on roads. Roads, roads are the major source of connecting rural India to urban India. So these are all these are all realistic examples which you can see in the market. So very important to understand, and you see how government of India introducing gold bonds, gold exchange traded funds, because gold, people were investing in gold, they were saving in gold, and that was resulting in leakages. Now government has gone for saying that you go for buying gold bonds, that means the money goes back to the government and government can go for investments and others that will be generating returns. So this is how, Karthik, it works. Okay, so let's revise for the day. If you have any other query, I'll take it. Otherwise, I'll revise and then I can ask you a few questions. You can write in this. Absolutely, Narega, absolutely. Yeah, sustainable goals also, yes. Absolutely right. Okay, so we are going to revise now whatever we have done. If you have any queries related to this, you can ask. Otherwise, I'll ask you questions. Let's go for devoting time of 15 minutes for this. And one of you wanted to ask about ex ante and ex post. We have already discussed, but I'll still share once again, because it's very important to understand all the chapters from last class onwards will be about ex ante and why ex ante is so important. See, any business you talk about, I'm establishing an analogy between business and country. Any business you talk today, if you're running your own business, or if you join some company, what decides that player to decide about more investments? When they see that people are going to create demand for that, when they see that potential in the market. So futuristic approach is very important, and that is what is ex ante. How prices are going to be in future, how the demand is going to be in future, how people are going to spend, where people are going to spend in the country, which products country will be demanding more imports, where we should have competence in exports, where country needs to go for more investments, where government should encourage corporate to go for more investments, how consumption pattern is changing over the period of time in India. So all these are ex ante, which helps government to make it policy measures. So national income accounting, what we did was ex post. Where we are in terms of GDP growth rate today is ex post based on the data, how the production has taken place over the period of time, how people have spent, how income has generated by factors of production. So this is all about ex post. So what is the GDP today is ex post. How because of COVID, GDP has got adversely affected is ex post. But how we can go for overcoming the gaps in future is ex ante. So government working on policy measures, strategic alliance, disinvestments is all based on ex ante. Okay, so ex ante and ex post should be clear to you, because henceforth we will be always referring to ex ante. So what we are talking about investments here, we are talking about potential investments. What we are talking about consumption here, we are talking about potential consumption tomorrow in the market in the country. Okay, so that is the difference between ex ante and ex post. Anyways, so we started with investment multiplier today, keeping into consideration that you know the concept of two-sector model. And investment, when we talk about corporate investment, so corporate investment leads to generation of multiple rounds of income. That is known as multiplier. Multiplier impact is that if you go for, if multiplier value is 3, then in that case, if you go for investment of 100 crores, income generated will be 300 crore, because 100 into 3 will be 300 crore. So multiplier value is 3. And this 3 value, how it depends on what? The multiplier value depends on what? Multiplier value depends on marginal propensity to consume. What is marginal propensity to consume? Marginal propensity to consume is change in consumption to change in income. If I write marginal propensity to consume as 0.8, that means if my income increases by 1 rupee, 80 paisa I'm consuming and 20 paisa I'm saving. And investments are injections. Why investments are injections? Because it infuses income in the country. Anything which leads to generation of income is injection, which absorbs income from the countries is leakage. What is the impact of investments? You can see here, investments leads to generation of income, and income in the country increases. Income increases from Y0 to Y1 because of investments. If investment increases by delta I, income increases from Y0 to Y1. Example, in the realistic world, we have already shared. Metro in Delhi, flyovers in India, roads in India, how it has helped, investments have helped to increase income in the country. So income moves from Y0 to Y1, equilibrium moves from E to E dash. And aggregate supply is C plus S, consumption and savings, and aggregate demand is consumption and investments. Since consumption is common, so at equilibrium, savings should be equal to injections. If investments are higher than savings, if investments are more than savings, economy will grow. Employment will increase. Output will increase. Income will increase. If savings are greater than investments, Reverse will be true. That is why investments are injections, savings are leakages. But if these two are equated, that is the position of equilibrium. And this you can see in the lower panel. This is the initial position, Y0. This is equilibrium. Here saving is equal to investment, but S is equal to I. If you go from E to E dash, you see here, investments are more and saving is less. That means corporate thought about, they are very optimistic about the market. So they have invested, they have more inventories, they want to produce more, they produce more, they hire more people, they create more job, people get more income, they spend and so on. So this is about increase in income. But if you see to the right of it, savings are more than investments. That means people are consuming less, buying less, demanding less. Corporate will be producing less, employment will reduce, output will reduce, income will reduce. So this is the scenario. So this is about the two sector model, savings and investments, okay? So this is what we have done. And this is the formula of investment multiplier. You can get the value of multiplier, delta Y by delta I. It is also equal to 1 upon 1 minus MPC. And you know as such that MPC plus MPS is equal to 1. So you can write this way also, you can write this way also. Depending on what is given to you, you can find out. How do you get this? You get it through consumption function. Consumption function is A plus B by D. B is what? B is MPC. Okay, so if you have been given consumption function, you can find out multiplier. Then the maximum value of multiplier can be infinity, but this will not be possible. Reason being, we have shared that MPC is always greater than 0 and it is less than 1. So it will never be 1. This we have discussed about. Now this multiple round of investments which leads to multiplier is that it depends on MPC. I've already shared with people. I hope it is clear to all of you. 200 crores of investments will lead to 100 crores of income if MPC is 0.5 in first round. Then so on and so on. Multiple income will be generated. But this process can stop because of few factors. Progressive taxes, we've already shared. What happens because of progressive taxes? YD goes down. What is YD? YD is disposable income. This depends on what? This depends on tax. And this depends on transfer receipts. Transfer receipts goes up, YD goes up. Taxes goes up, YD goes down. YD goes down, MPC decreases. MPC decreases means multiplier impact will be less. High liquidity preference means you want to keep more cash. More cash means you are not spending. You're not spending means MPC is low. MPC is low means multiplier reduces. Excess of inventories, investments, if you go for more inventories, if corporate have more investment done already in inventories, they already have huge stock of inventories, then in that case, they will not go for further production till those set of inventories get absorbed. If you go for more imports, then in that case, imports are more means you are producing less in your country. You are producing less, you're generating less income. You're generating less income, that means MPC will be less. Then investments, if you invest in shares and bonds, but if it is leading to savings equals to investments, then it is fine. But if saving exceeds investments, then it is a problem. If there are more debt obligations, you will not be able to. So this is which kind of expenditure? Your revenue expenditure. You should have capital expenditure. Capital expenditure means you go for more output, more production means more jobs, more employment, more income, higher MPC. But if it is a revenue expenditure, then in that case, you will not be generating employment. You will not be generating income. This will not lead to MPC. Scarcity of supply despite high consumption. There may be demand, but we have supply constraints. We are not able to produce enough because our productivity is less. Labor is not that productive. Capital is, we are not able to have best of the technique of production. That results in lower productivity, and this results in lower income generation. This income generation leads to low MPC. If economy is at full employment, which is not feasible in India, if it had been in that case, it will lead to high inflation. Full employment means that the resources are fully utilized. Fully utilized means either you are having less potential or the resources are not fully utilized, then only you can grow. So this we have discussed about. This is the equation you can see here. They have given you saving function. In case they have given you saving function, if you have got saving function, then also you can calculate multiplier, because you know if they ask you multiplier, what will you do? The saving function is MPS. This is MPS, no? This is MPS. So we have shared K is also equal to 1 upon MPS. Sorry, MPS. So you can calculate multiplier through this also. If you have to calculate consumption, you can calculate consumption, because saving function is just reverse of consumption. So this becomes, saving function is minus A plus 1 minus B Y. Consumption function is A plus B Y. Okay. And in two-sector model, how do you get equilibrium? Equilibrium is Y is equal to C plus I. So I is given to you, S is given to you, you can convert to C, you can find out Y, you can calculate equilibrium level of income. Once you get income, you can calculate consumption by substituting here. Income is there. This A is given to you. This A you have here. B you have got. You can calculate consumption. You can get consumption. You can get investments. And you can find out multiplier, because they have given you change in investments. What is the formula? K can also be written as delta Y by delta I. You can write 1 minus MPC. You can write 1 upon MPS. You can find out multiplier. Then three-sector model, what you have to take care about in three-sector model, that how households and government and business interact. Government gets tax proceeds from households, from business. Government has to make expenses towards household by giving them transfer payments on certain things, and similarly subsidies to be offered to business units. Government can borrow from the financial market. Financial market get money through households because they go for savings. Even corporate, they take it from financial market because households, they go for savings. They can borrow for investments, and they can incur investment expenditure, which leads to production of goods and services. This is known as injections. Government also goes for purchasing goods and services from the product market. Business units, they produce goods and services. Households, they purchase goods and services. And factor market, they take care about factor payments. Who pays them? Business units are going to pay them, and households are going to render their factor services. So this is about a three-sector model. Then numerical also, we have done the concept of lump sum tax. Lump sum tax is basically reduces in one go from the disposable income. Lump sum tax is tax which is not dependent on income. Okay, so you can calculate here the concept of multiplier. When the tax rate is given to you, I've already shared few formulas which you have to remember for this particular unit. Tax multiplier. Tax multiplier, how do you get the tax multiplier? Tax multiplier K is equal to 1 minus B, 1 minus T. This is which tax? This tax is dependent on income. That is why it is minus here. If this would have been autonomous, then we will not take care here, isn't it? So this is how we calculate. So this is the tax multiplier. Government expenditure multipliers K is equal to 1 minus B, one and the same. B is nothing else than MPC. And foreign trade multiplier will be 1 minus B plus M. So this we have already done. This I've shared with you. You understand this tax rate, autonomous tax rate, and others. And we have seen what is the impact of the tax rate. Tax rate leads to decreasing the impact of multiplier from 2 to 1.82. So that is leakages in the system. Then four sector model. For the four sector model, what you have to remember, there is component of rest of the world. This rest of the world has two major components, exports and imports. This is how we interact with the rest of the world. Apart from that, another component is net capital inflow. Net capital inflow is capital what comes to the country, capital which goes out from the country in terms of factors of factor services rendered and factor services paid and other factors of production. So this is net capital inflow, which you can see its arrow is going down towards factor market. And who are there in factor market? Factor market are land, labor, capital, and entrepreneur. This is how people buy land abroad, people invest abroad. Foreigners, they invest in India. Indians render their services abroad. Foreigners, they come and invest, render their services. They go for capital, Indians go for capital investments, and they go for entrepreneurship. So this is about net four sector model. And this is marginal propensity to import. Very important for foreign trade multiplier. You can see here, and we have already shared the concept of countries which outperform because of export multiplier, and some are not able to do very well. So this is the concept of export multiplier. Okay, so export multiplier, X minus M, you see here, X minus M. So the leakages and injection become saving, taxes and imports, and injections become investment, government expenditure, and exports. If these two are equal, that is the position of equilibrium in the economy. Okay, if savings are more, Ankur saying fifth batch may all subject classes provides. Yes, all. They have started with economics and accounts, I believe so. Rest will be taken care. Yes, all subjects. Hindi mein yogita, what to explain in Hindi? Everything is clear, I believe so. Injections is basically जिससे income बढ़ती है. Leakages जिससे income कम होती है. Injections basically all kind of investments in the country leads to injections. और leakages जैसे imports हैं, जैसे taxes हैं, savings हैं, if they are not channelized in the right manner, people go for putting their money in lockers में रख दिया, अलमीरा में रख दिया, that means what is happening? The money is not coming back. So it is a leakage. Leakage means impact will be less because banks will not be having enough money to lend. और अगर उनके पास lending के लिए नहीं होगा तो उस केस में corporate will be relying on others market to get loans. तो उनके पास liquidity crunch हो जाएगी, they will not be able to invest. So basically savings, taxes and imports जो है leakages हैं. Investments, government expenditure and exports are injections. Another important factor जो आपको याद रखना है, किसी भी कंट्री का ग्रोथ डिपेंडेंट होता है कंजम्पशन ड्रिवन इकोनॉमी पर. कंजम्पशन इज मार्जिनल प्रोपेंसिटी टू कंज्यूम. If you have higher marginal propensity to consume, that will help country to have more production. तभी तो corporate produce करेंगे. That is why you see the segments where there is demand. जैसे आप देखिए MBA colleges, number of MBA colleges going up. Why? Because there is demand. So जहाँ पे demand होगी, जहाँ पे लोग spend करेंगे, वहीं पे तो production होगा. Production होगा means jobs will be created. Jobs created means more money in hand. More money in hand means you can go for more spending. More spending means it creates more demand. Okay. So 0.5, I don't know Mukta, which 0.5 you are talking about. मेरे ख्याल से leakages की बात कर रहे हो आप. You're talking about this. High debt obligations. Mukta, you're talking about this 0.5. See, high debt obligations, basically what happens, अगर आपकी loan obligations ज़्यादा हैं, so that is what? You are paying for the loan only, no? If your loan goes up, you are paying for the loan. अगर आपके पास loan का ही आप repayment करते जाएंगे, तो when will you go for investments more? Investments नहीं होंगे तो growth नहीं होगी. So जितनी ज़्यादा liabilities आपके ऊपर होंगी, उतना कम आपका consumption होगा ना? So debt obligations make you're liable to pay, isn't it? And because of this, you are having less for consumption and growth. So I hope it is clear to all of you. I believe we have covered everything. Anyone has any doubt, I'll take it, and then otherwise I'll wind up for the day. Okay, so Mukta, I hope it is clear. Tax multiplier. See, tax multiplier basically क्या होता है आदित्य? Tax multiplier, आप disposable income समझ लो. Disposable income is what? Disposable income is income which you have after deducting your tax liabilities. तभी तो अगर tax बढ़ता गया तो आपके पास income कम बचेगी. और income, that is why you see when the budget is announced, people feel that लोग क्यों कहते हैं कि tax rate कम हो? अगर टैक्स कम होगा तभी तो आपकी इनकम ज्यादा होगी. इनकम ज्यादा होगी तो आप स्पेंड ज्यादा करेंगे. स्पेंड ज्यादा करेंगे तो देन इन दैट केस यू कैन बाय मोर, यू क्रिएट मोर डिमांड. तो टैक्स मल्टीप्लायर में दो कंपोनेंट्स होते हैं. एक लमसम टैक्स. लमसम टैक्स इज नॉट डिपेंडेंट ऑन इनकम, बट प्रोग्रेसिव टैक्स जो होता है, प्रोग्रेसिव टैक्स किस पे डिपेंड करता है? इनकम पर. जितने ज्यादा आप हायर इनकम ब्रैकेट में फॉल करते जाएंगे उतना ज्यादा आपका टैक्स रेट बढ़ता जाएगा. और अगर टैक्स रेट ज्यादा और ज्यादा बढ़ता जाएगा उस केस में यू विल बी एबल टू स्पेंड लेस. सो इसीलिए टैक्स मल्टीप्लायर नेगेटिव इंपैक्ट करता है. ओके, एंड दैट इज व्हाई हाउ वी राइट टैक्स मल्टीप्लायर इज 1/1 माइनस बी 1 माइनस टी. ये कौन सा टैक्स रेट है? जो प्रोग्रेसिव टैक्स रेट है वो टैक्स आप माइनस करते जाते हैं. ओके, सो दैट्स इट फॉर द डे. Okay, then take care, all of you. Bye.